Hi and welcome back. In today's video, we're going to be talking about mortgages and APRs. So let's get started. If you don't know what I mean by the term APR, then check out this video. Now, mortgages generally have the most fees associated with them in terms of different types of loan opportunities out there for the average individual, and as well as it generally tends to be the loan with the longest amount of time. So because of all of that, I've decided to make a video just to cover some of the fees that are associated with the loan so you can understand what might be calculated in the APR and what might not be. In the United States, the Truth in Lending Act requires that mortgagors disclose APR as well as other important loan information in an easy to read disclosure so that way you understand what you are agreeing to. Now, the disclosure includes the loan amount, APR, finance charges, fees, prepayment, penalties if there are any, payment schedule, and the total amount that you will pay, assuming that you make a consistent monthly payments and don't pay extra. Now, APRs generally include fees, and therefore we're going to be talking about some of the fees that can be included. Now, not all lenders include all fees, so when you are comparing two different mortgages, you may want to talk to the lender to see what fees are being included in each APR, so that way you are making a true comparison between the two, because a fee may be included in one and not included in the other. So let's talk about some fees that are generally included in APR calculations. Administration fees, so application fee, mortgage insurance, mortgage broker fees, audit fees, certain closing fees, escrow fees, so you got your origination points, discount points, again, processing fees, refinance fees, and underwriting fees. Now, there are also other types of fees when it comes to mortgages, and the ones I'm going to be talking about next are generally not included in APR. Appraisal fees, survey fees, title insurance and fees for the title, notary fees, pest inspection fees, builder warranties, and prepaid items on escrow balances such as taxes or home insurance. There's also something called intangible taxes that are not included. So again, as I stated before, that how an APR is calculated can be different across lenders and across loan products. So you want to make sure that you talk to your lender and get a good idea so that way you can make a true apples to apples comparison. Now, another fun fact about mortgages is that they could be on a fixed interest rate or a variable interest rate. So let's talk about that. Fixed APRs. So loans with fixed APRs are loans where the interest rate doesn't change for the entirety of your loan. Fixed rates generally are higher than advertised variable rates at the time of purchasing your home, but again, they are fixed, so there won't be any types of change. Now, with fixed APRs, you also potentially have the option of doing what's considered a buy down of the rate. So a buy down, sometimes called buying mortgage points, is the idea where you can permanently lower the interest rate associated with your loan by paying about 1% of the total mortgage. So each mortgage loan point is worth about 0.25% of an interest. Now, generally, there are mortgage loan companies that have a cap on how much you can buy down the rate and lock it in. So that's something that you may want to consider. Another thing to note is that in order to break even with the amounts of savings from lowering the interest rate by 0.25 is it takes about 5 years of making payments for that break even point. Variable APRs. So loans with variable APRs means that your APR is going to be variable and will change throughout the duration of your loan term. These rates tend to both rise and fall, and they are generally tied with index such as the federal's fund rate. Another thing that you need to know, borrowers, is that there is generally a component part of that rate that is tied to your credit score. So there is a small portion of the rate, as it is variable and changes, that is also tied to your credit score. So having a better credit score at the time will lead to a slightly lower rate. This component is called a credit margin, and credit-based margins is again based on credit. Now, when you are considering a variable APR loan, you have to also consider how long the loan is going to be, because generally the longer the loan, the more chances of having rate fluctuations are going to occur. So let's add another acronym to your tool bank, and that is ARM, or adjustable rate mortgages. Now, ARMs are generally denoted with two numbers. There is one number, then a slash, and another number, and I'm going to be putting this on the screen as I talk about it so it makes more sense. Some examples are a 10-1 arm, a 5-1 arm, a 5-5 arm, a 3-1 arm, or a 3-3 arm. So that first number stands for the number of years you have that fixed initial rate. And then the number that is after the slash is how often that rate gets reevaluated after that. So now that we talked through that, here's a table that shows what these arms actually convert to looking like. Now there are a ton of arm products out there, so you could find numbers that are different than the ones that I just had on the screen. There's also the ability to find ones that have different adjustment periods. So some arms could have an adjustment period of as little as 6 months, but I have heard that there were other products out there, so there's a possibility that there are even more. But in general, from what I have seen, it's 6 months, a year, 3 years, 5. So yeah, that's a little bit more information on APR and mortgages. So just talking about some of the fees and then talking about a fixed rate versus adjustable rate. If you have any questions, leave a comment below. If you want to calculate APR, I'm going to highly recommend, again, a financial online calculator to plug in numbers to get those type of rates. The calculation on doing this is something that not even I really want to tackle. If you found this video and this is the first time to the channel, welcome. I hope you found it helpful. If you did, consider subscribing. For those who are subscribed and have been tuning back in, thank you so much. And as always, I am here and happy to help. So I will see you in the next video. Bye.